I was always fascinated with not only making money but trying to grow it. And
Hmm.
the most successful people that so I grew up in this part of Queens, Astoria, which was like an immigrant, kind of neighborhood. A lot of Greeks and Italians, kind of off the boat, and I saw people kind of, these immigrants, take their money, invest, and did exceptionally well. And I was always fascinated with the concept of like how to best invest. There's real estate, there's obviously small businesses, and I just thought that finance was an easy way. So.
Hello, everyone. I am Brittany Mason. I am your host for The Alternative Mason, and we are back with another episode. I'm very excited today because we have John Davi with us. John Davi is the founder of Astoria and brings over 25 years expertise in macro ETF strategy, quantitative research, and portfolio management. Before launching Astoria in 2017, he led Morgan Stanley's institutional ETF content and portfolio solutions for some of the world's largest asset managers. He began his career at Merrill Lynch in 2000, where he helped pioneer ETF portfolio construction and raise billions in assets. So I like to just dive in, to your background and your journey and how you got started, in the finance industry in general. Was finance something part of your childhood? Was this something that you started in young, or did this come later on in life?
Good question. I would say that I was always fascinated with not only making money but trying to grow it. And
Hmm.
the most successful people that so I grew up in this part of Queens, Astoria, which was like an immigrant, kind of neighborhood. A lot of Greeks and Italians, kind of off the boat, and I saw people kind of, these immigrants, take their money, invest, and did exceptionally well. And I was always fascinated with the concept of like how to best invest. There's real estate, there's obviously small businesses, and I just thought that finance was an easy way. So.
So you learned that really young. You'd say a lot of your childhood. How do you? That's interesting how it shaped you. So, what was your first job?
First official job was I was actually in college, and I worked at a mutual fund call center, and I was like processing trades and kind of talking to investors about mutual funds and how to allocate amongst the Dreyfus mutual funds. I did that during college. It was actually like a full-time job ish that you could have gotten like after college, but I was able to kind of get my foot in the door. And then I left that to be an intern, so kind of go backwards, like take a step back. And I was an intern in Merrill Lynch's equity derivative research group, and I did that in my senior year of college, and then I joined the Merrill Lynch Equity Derivative Research Group as an analyst once I was done with college. So, and I spent like my first 10 years at Merrill Lynch in the derivative, kind of research group and the trading floor. So.
What was that like, being part of that so early on? I mean, it must have shaped your career tremendously that early on.
Yeah, Merrill Lynch in the late '90s, early 2000s was definitely like ahead of the curve in terms of they created like these holders products, which were like basically like the first generation of ETFs, kind of fixed baskets that didn't rebalance. Anyway, you'd buy like the internet holders. I'm gonna I'm gonna call it a fund because it wasn't an ETF. There was like no creation redemption, but um, so Merrill Lynch was a great place to work. My first boss was this guy Steve Kim. He's an exceptional talent. Merrill Lynch was very early to get into like the model portfolios, which is kind of the space that Astoria is in now. So we would take like our strategist views and then kind of put ETFs around it. And I was involved in that in the early 2000s. So it was a great place to work and learn for sure.
Did you have any mentors that you could give credit to that helped shape your direction? Was there like a pivotal moment where, because clearly, if you're doing something similar with the company that you've founded now with Astoria.
Yeah, I mean, the guy that kind of had the group was this guy Steve Kim, and very smart, talented, exceptional. And he just took a shot. He obviously had access to a lot of different people and colleges, but he wanted somebody that he can kind of train and mold. And I didn't really have any deep derivatives background, but he kind of trained me and helped me a lot. So I give him a lot of credit. I mean, I've had other sort of good people guiding me over the years too, but he was the one that kind of like started for me.
Love it. How would you describe derivatives to our listeners? I know we have a very diverse type of listener. Of course, we have people who are specifically interested in alternatives and alts and how they work, and but we also have newer independent investors as well that are listening, and people who are newer to the industry. So, could you just explain to our listeners how they work and what they are?
Derivatives, yeah.
Mm-hmm.
So it could be as simple as like, a call option on a stock. If you think a stock is expected to go up, you can put, $100. If you had like $100 to invest, you can buy all $100 and buy Delta, let's say, buy the underlying stock, or you can just buy a call option that costs maybe like $2, $3, and kind of like keep the rest to invest in other things, and you kind of limit your losses to just the cost of an option. That's really like one of the most kind of basic fundamental, and the way I would sort of make the analogy to people that aren't familiar with derivatives is that sports players have like a option year 5 of their contract. They could exercise, they don't have to exercise, and that sort of logic applies to like a call option on stock. You're entitled to buy it at a certain strike price. There's a maturity. You can extend the maturity, you can unwind early, but you kind of limited your losses to just the cost of that call option, as opposed to if you to just take $100, buy the stock, it could in theory go to zero the stock and you'd lose all of it. um, so that's just like your basic explanation. That's one option, I would say.
Nice. So, as far as see this, you got involved with this type of, these types of strategies through Merrill Lynch, and then founded Astoria. So, how, after spending years at major institutions, what inspired you to launch Astoria in 2017?
Well, the goal was to always kind of be an entrepreneur, and I did want to manage money, so I thought let's kill two birds with one stone. Um, so I had spent like a good 20 years working on the sell side. I thought I accumulated a lot of skills. I work with some of the largest institutions in the world, biggest hedge funds, biggest asset allocators. I'd go to Japan, Denmark, Sweden, talk to like central banks, big firms, and I just thought that I can take my knowledge of macro quant derivatives and kind of build portfolios for financial advisors. Um, ETFs were certainly not new, but at the time I thought it was like let's say like the third inning of the ball game, and I thought there was like a long runway. So I think at the time there was maybe like 2-3 trillion in ETF assets. Now it's at 10 trillion, and I just thought to have a firm that kind of dedicated to building institutional caliber strategies for financial advisors, I thought I can have some edge. And investing is about having edges and leaning hard on those edges to try and get the outcome you want. So that was the idea. And I was obviously younger than I am now, so probably had a little bit of naiveness. But listen, it's been a great ride, and I enjoy every minute of it.
What would you say is like one of the biggest risks that you took early or in those early days of founding Astoria, and how did it pay off for you?
Well, I mean, to start a firm with like no track record, there is a Gibbs composite track record that goes back to 2010. Um, but in reality, advisors want to see the firm kind of up and running for X number of years, whether it's 3, 5 years. So it was very very hard in the beginning with not a long firm track record. So that was challenging. Performance I think is good, and I think we have past performance on indicative future results. But just those early years were really tough when like people like who are you, like where are you calling from, and what do you want from me. So that was challenging and a risk at the same
Hmm.
time, but I think it's all it's working out, and it has worked out.
As an entrepreneur, how did you know it was the right time? Because timing is so much. I mean, it can be so important. Sometimes you're too early, sometimes you're too late.
Yeah.
How did you know it was
Well,
the right time?
we were living in a zero interest rate environment where interest rates were at 0%, for most of like the 2010 to 2020 period. So I left and I started a store in 2017. And, I just thought that, kind of like it was such an unusual period. The whole interest rate environment has changed dramatically the last, 3, 4 years. And
Hmm.
it feels more normal now. So I think, you kind of got to get in early. S&P was probably like 14 p ratio. We're now sitting at 22 and a half p ratio. So I think, it's been a great ride for equities, and interest rates have normalized. So
Hmm.
I think that's, the timing, sort of worked out. ETFs were like 3 trillion assets, maybe 4. Now we're at 12 trillion. So, we think we've caught that wave. And when I left, for instance, Morgan Stanley, I didn't have an NTD set up, a single client, um, and we have now $2.5 billion that we manage. We have something like 1,700 accounts with 4 publicly traded ETFs. So, we benefited from that tailwind of like rise in stock prices, ETF inflows. So,
So tell me more about Astoria's philosophy and the foundation of the culture for what you've
yeah,
built.
so we have a lot of research, a lot of content. That's what we want to pride ourselves on. Um, I would say we've got 5 CFAs on staff. 4 of them are on our investment committee, and we really try and marry like macro and quant. And so we like to say we're at the intersection of the two. I find some of my peers are just pure macro and they make big bets based on macro views, or some people are just like very quant and say, I believe in value or small cap and DFA, and we're really kind of the intersection of the two. And then we have like, I'll just give you a little intro, but we have 3 verticals. Um, so basically, the first vertical is like our managed ETF portfolios, which are like outcome oriented. It could be like income oriented. It could be risk based. But we have about $1.8 billion in that, and it's a suite of ETF managed portfolios. The second vertical is our quant stock selection models. We have about 200 million in that, and that we're mining for the alpha and the beta. So we're starting with like a large universe of stocks and ultimately drilling down to like 40, 50 that we think best represent that factor. It could be quality, dividends. And then the third vertical is we're an ETF sponsor, and we've got 4 ETFs, 2 equities, 1 fixed income, and 1 alternative. And I think like we're sort of, you know, very rare that we kind of have these 3 buckets that I mentioned. I find some people just in 1 or maybe in 2, but not in all 3. So
So, but that's a diversification. It's so important, right? Is that, you know?
yeah, it's the only free lunch, in the market, which not a lot of people, want to diversify nowadays. If I'm being honest, people
Really?
thinking portfolios are just about, owning spies and Qs and maybe some bonds. But yeah, you have to be diversified across your portfolio and in your business segment for sure.
Hmm. How do you balance quantitative research with real world human decision making?
So, good question. I would say, having spent 20 years on trading floors before Astoria started, we were always, you know, technology and computers came at trading floors really hard and fast 20 years ago.
Hmm.
And the best solution was always, human interaction with technology. And it's the best of both worlds. I find now, like in finance and, investment management, like people are really scared of AI. And I
Yes.
would say, like, having so much experience with, you know, being disrupted, like finance has always been disrupted. I think you want to, like, so we have like AI, we have technology tools, but we have a lot of humans that oversee it. And I think marrying the best of both worlds is the best outcome you can get.
Mm-hmm. How are you utilizing AI these days?
Well, I mean, we have access to large language models. I would say that we use it for system checks. Sometimes when we publish articles, we'll takes kind of the place of a human. They can just do stuff for us like a lot faster. They allow us to
Mm-hmm.
kind of scale. Um, but a lot of our quant code is still done within like the traditional tools like FactSet and Bloomberg, um, and there's still like the human element over it. I think the AI within our firm is more so in like the sales and marketing,
Mm-hmm.
like note takers for the salespeople to do calls with advisors and then have that, transcribed and then put into their, CRM.
Mm-hmm.
Like that's something that's kind of new, but that's centered around like sales and marketing.
What do you feel people most heavily misunderstand about ETFs?
you know, I think it's definitely still like there's two sources of liquidity with an ETF, right? One is the primary market, which is what like screen liquidity, and then the other is like the creation and redemption process, like the fact that you can create additional shares to source liquidity. The biggest challenge we have as a smaller issuer is that people like our strategies. They think that we have alpha, but then they go on the screen and they see only 10,000 shares traded, and they need a lot of education to kind of how to tap into that secondary liquidity. So that's always been like a tough thing, but I think that's still the primary concern. That, and we still have like advisors that are concerned about fixed income ETFs, and like how efficient are they and whether they should buy like fixed income mutual funds. But these conversations I've been exposed to for like literally 10, 12 years now at this point in terms of the fixed income.
Mm-hmm.
And in ETF liquidity, it's been ever since ETFs came out, that's been a concern for people.
What role do you see alternative strategies playing with ETF based type of portfolios then today?
Well, I know like your firm has alts and
Mm-hmm.
alternative solutions, and I think that's still like an area that could be tapped into, like hedge fund replication. I see like a lot of private equity, private credit ETFs trying to be put into an ETF. I think that's still like an ongoing, and obviously like all the crypto is a rage. Like a lot of different crypto strategies are being launched as an ETF. So the space is still small compared to like traditional stocks and bonds. But I know on our side we make a lot of our money through like our usage of alternatives. So I'm very keen on seeing like more alternatives being put into ETFs, because to be a diversified investor, like we talked about earlier, like
Mm-hmm.
the more solutions that are out there, the better. And the alt space continues to be prime for more disruption.
How so? How do you think? What excites you most about alts?
Well, I do think that like traditional stocks and bonds, are well represented. There's a lot of, I mean, you could buy one of 40 ETFs for like large cap US, broad or sector. Within the alternative space, there's not that many.
Mm-hmm.
Um, we've been living in like now a structurally higher inflation world for 5 years,
Mm-hmm.
and we run in an ETF um, that kind of tries to solve for higher inflation. This concept of like currency debasement, and I just think that that area is underrepresented and
Mm-hmm.
should be used more, because if the goal is to get higher up on the efficient frontier, there's a couple of ways to do it. One is you could take leverage, capital efficiency. Another is just to protect your downside. And I know people think that stocks go up every year. I've lived through 10 years when stocks went down for 10 years.
Mm-hmm.
So I really like the alts ETF space, and I think it's still very prime for disruption.
Do you have any predictions of disruption for the future? Or what would you
I
like to see?
um, I think the crypto space is interesting to me, like alternative, uh, stores of wealth, and I'm excited. I mean, I think nobody had in their crystal ball that the Bitcoin ETFs would accumulate 100 billion in assets in two
Hmm.
years or whatever the number is. So I think there's a lot more to come in that space. I'm really excited about that.
I went to the Bitcoin conference earlier this year. There was a lot going on. It was pretty exciting. I'd like to learn more about that space as well.
Yeah, absolutely.
So, in the last decade, how alternatives have evolved, I would say real estate is always like one of the biggest conversations for investments, but I've been hearing a lot of different feedback lately of people maybe not investing as much. What do you think? Do you think it's still a safe investment strategy?
Real estate.
Mm-hmm.
Yeah, I mean, I put it in like the real asset bucket. So like tangible, physical assets. Um, we started adding like physical real estate companies, data centers, power plays.
Mm-hmm.
And if you think about like the AI build out, I mean, it's really exciting, like what's going on in that space. Um, so, some of these utility companies have become like, now growth stocks and growth oriented. So I think the space is like really interesting. And, we certainly have been advocating for it within our PPI strategy. Um, so yeah, I mean, there's like demographics, right? In this country, we've got 380 million people. There's 120 single family homes. There's a complete, supply demand imbalance. So, I sort of like that symmetry, and it feels like something you can lean on.
Do you think the average person should still be prioritizing buying a home?
Well, I think it goes into like their personal situation, but like for me, like growing up in Queens, um, I mean, this may sound, I don't know where you were born and raised, but like the property values that I've seen in like Brooklyn, Queens, Manhattan have just like gone up exponentially.
Exponentially,
And
yeah.
yeah, and I think like, it was always in like the big metropolitan cities like Chicago, LA, San Fran, Virginia, DC, New York. But you're starting to see growth outside of those regions too, which I think happened. I mean, COVID definitely accelerated it. But I always say like a physical real estate is always a good asset to own in your entire portfolio.
I agree. I just saw I don't know if you saw Maxwell House. They're pretty clever marketing. They just released Maxwell Apartments. So,
Oh, really?
yeah. Yeah, as acknowledging the lack of homes being purchased by millennials and Gen Z. So, yeah, I just wondered what I've been hearing different mixed opinions on real estate, and newer investors, where should they primarily be focusing on pushing their investments?
Yeah, I think interest rates will come down. Kind of having been exposed to Trump, being in a New York, New Jersey guy, and did a lot of real estate in Jersey and New York. He's going to want lower interest rates, and that should be like a further tailwind for
Mm-hmm.
physical real estate. So, I think Powell's got kind of an expiry date, right? So next kind of spring, and I think that he's going to put someone in there that'll lower interest rates because that's what he wants, and that'll be the next leg higher for real estate, in my opinion.
Well, I hope so. I'd like to see some of those, some of that come down. I think we all would. We could all use a little bit of a break.
Yeah, no, I hear you.
So, what alternative strategies do you feel have been overlooked for investors right now? What do you think we should be paying more attention to?
Well, I have a horse in this race. So we launched PPI 3.5 years ago, actually almost 4 years ago. And at the time, CPI inflation was, 4 on its way to 9. And we
Mhm.
thought that we'd live in a structurally higher inflation. So we definitely think that portfolios need to go away from just nominal bonds and just nominal exposures. JP Morgan put out a pretty big report saying like the currency debasement trade, and that was a rationale for why gold is going up and Bitcoin. And, investing is about having like a forward looking view and looking beyond, 6 months, 12 months. And our fund is up like almost, I think it's like up 29, 30% year to date. It's beating the S&P by quite a bit. Since we launched it 3.5 years ago, we beat the S&P by over 20%, and the valuations are pretty low. So I do think that people need to kind of go beyond just traditional stocks and bonds. I know your firm, you do preach alternatives. Um,
Hmm.
I do think that private credit and the private equity space, there's a lot of money going into that, and I'm concerned that it's chasing too far deals. But your traditional just allocate towards like gold, some commodities, has worked well in this current cycle, inflation cycle that's now almost 4 years plus.
Hmm.
So that's what we think portfolios need to evolve to, is owning more real assets, commodities, fixed supply assets.
Hmm. What are some of your favorites? Any in particular?
Uh, we do like Bitcoin. I put out a report at Astoria when Bitcoin was at $10,000. It's obviously now like 120 ish. Um, obviously the ETFs have only been around for I think 2 years. So we are advocates for gold, Bitcoin. We are using PPI in our own managed portfolios. Um, I'm a big fan of real estate, like physical real estate. I've got a rental property at my primary homes, and those have been very good investments. So all of the above is kind of what I would sort of advocate for, and what we're doing for our investors at Astoria.
Diversify, but you said people are not wanting to diversify much lately.
It's always a challenge because stocks keep going up, and S&P is up 14% year to date. Back to back 25% years. Um, it is challenging for sure, but on the margin, I think it is slowly happening.
So, what do you see in the next 5 to 10 years for Astoria? What excites you most?
Well, we want to grow for sure. We want to expand our team. Um, I think our plan is not to have 20 different ETFs, but we definitely feel like we can come out with one per year that'll kind of solve a need for our investors, and then like
Mhm.
outside investors will also take suit. I'm very excited about the usage of AI for sure. I think the crypto space is really really interesting. People didn't give it enough credit, but I think it's proven just based on the flows that we've seen. So the combination and the intersection of technology, AI, invest in finance, more efficient portfolios, that's a space we want to be in, and helping get better outcomes for our advisors. I mean, that's like our stated mission.
So, if you could tell anything to that kid growing up, your younger self in Astoria, what would you tell him?
Take risks, calculate it, but take risks because the reward is great, and there is a fundamental like if you take more risk, you should be rewarded. And I've seen that happen in my career and other people's anecdotally. So, you know, America is sort of prime for, that entrepreneurial spirit. And, I have a 4-year-old son, two teenage daughters too. But, I would tell them all like, just go for it. You take risk and work really hard and you'll be rewarded.
What are you teaching them as far as the foundation of finance goes?
Like compounding your money over time. Like, so I am definitely preaching to them, like, be in the market, let your money compound. Um, it's been a great cycle the last, 10, 15 years. So don't just assume that US is the only game in town, diversify across the globe. But the more you can kind of invest and compound your money for long periods of time, I mean, it really does wonders for your overall financial health.
Mm-hmm. Mm-hmm. Are there any tools that you recommend new investors using? Any apps or anything to help them manage their own money or their own portfolios?
I would start with some books, just to kind of read some of the seminal foundational books, like, books, Random Walk Down Wall Street, a lot of the John Bogle books. I really got into like some of these hedge fund guys, like Howard Marks. He's not a hedge fund, but there's some really good books written, like, document and interviewing hedge fund managers and kind of reading how they assign risk and how they take risk and measure it. The more you can read, I think the better. I think first you have to learn about like finance, and then I
Mm-hmm.
think you can use apps. Um,
Mm-hmm.
but I hear you though. A lot of people like getting apps to trade, but I think some of these apps are doing like more harm than good.
Oh, okay.
Um, yeah, so I think before you start trading, 0 day options, you kind of have to understand what the stock is and whether it's good or not. So
Mm-hmm. Where do you find your best research?
um, well, we do a lot of our own research, a lot
Mm-hmm.
of using data. But some of the books I think like would be a good place to start. And then once you get like the principles down, then it's like easier to like have the impact that you're trying to solve for.
Do you have any favorite podcasts? Do you listen to a lot of podcasts or more reading?
Um, I do like Jeremy Schwartz's podcast. He's got like Professor Siegel. Um, I can't remember the name. It's like the Warren Business School podcast.
Mm-hmm.
I do listen to like the All In podcast, which that's not just about finance. It's kind of the intersection of like finance, investing, politics, science. Um, Matt Faber's got a really good podcast, more so dedicated to finance. Um,
Was there a moment where you knew Astoria made it? Did you have like an aha moment where you were like, "Oh, we made it. We're in now."
um, we got a lot of traction when we launched our PPI ETF. It was kind of the first to market.
Yeah.
That got a lot of like good accolades. When you run SMAs, that's one thing, but having an ETF feels real. Um, and then like we did a second one, and that also got very well regarded. I think over the years, like we launched a third one, a fourth one. We host like an annual conference. Actually, I have Shanna speaking on my
Mhm.
conference at the Nasdaq. And if you go to storyadvisors.com, you'll see kind of like the people, the sponsors. But last year when we hosted it, we had like 150 people, and that really felt good because like all right, now we were able to kind of fill up a room with some of the best thought leaders out there and the
Mhm.
biggest firms sponsoring, and that sort of felt like a big moment for us.
You said that was last year,
Yeah, and we're coming up on our second one in October 20th. So
October 20th. All right,
yeah.
fantastic. All right. Is there anything else you would like to leave our listeners with before we go?
Just learn as much as you can.
What would you say are the top 3 traits you have that have contributed for your success?
Um, Work hard, learn as much as possible, and then like rinse and repeat
Every day, every day. I love that.
every day.
All right. Thank you so much, John. That is the time we have. I appreciate it for you taking all the time that you've got to give us these wonderful insights. Thank you, everyone who has tuned into this episode with John Davy, and we will see you next time right here on the Alternative Mason. Thank you so much.
Thank you so much.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparisons are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of capital. Please seek advice from a licensed professional.